it's a different environment that we're in. It's not, I'm not a believer in the kind of new age, new paradigm. Whenever someone talks about that, run for the hills. In a sense, it's kind of a return to the old paradigm, how we used to invest before the Fed, I think, had to get very heavily involved in markets over the past 10 years or so. So look, first of all, here's a disclaimer, of course, which tells you everything I have to say today is of a general nature only. And what is better than one disclaimer is two disclaimers, 2 pages of disclaimers. So that hopefully should cover it all, and hopefully you've all read that in the last couple of seconds. Clearly, we've got a very conservative legal and compliance team, which I think is a good thing. So look, I'll talk about rotation of value. I'll talk about valuation still turning, rate hikes and what we see there, inflation, supply chains, and then lastly, rounding it off, what it means, we think, from an investment point of view. But look, first of all, Australia's a bit different to the rest of the world. We are certainly ahead of the curve in terms of rotation. All this chart is showing you is what value stocks are doing relative to growth stocks. And you can see there it's pretty rhythmic. It tends to rhyme a lot. History doesn't repeat exactly, but it rhymes a lot. And we're getting the same old rhyme, which is basically that after a period below the line where growth stocks do well, every 10 years, you get a tremendous amount of money come into the market. It causes a big lift in property, causes a big lift in tech stocks, all those sort of things. And then that all comes to an end, usually when there's been too much stimulus applied and the central banks have to put on the brakes and turn things around, and we see value stocks start to head up. And value stocks are things like energy, the banks, miners, some consumer companies as well. I'll go through that a little bit later on. But certainly that's the sort of trend we're in. And in all likelihood, if we see what's happened in the past 20, 30 years, that trend will continue. Value stocks will continue to go up. So it is a bit amusing. I mean, no one can be sure, right? But it is a bit amusing when you see, there is this behavioural problem called there's a couple of behavioural issues out there, but one of the most pernicious of them is when people take the last 5 years and roll them forward. It's called anchoring. And they become anchored on the recent past. And when you become anchored, you can't really see the future properly, because the future really is in 10, 15, 20-year cycles. You've got to look at what happened before. And of course, if you're anchored, you thought that trend below the line was going to continue on, just like you probably thought it was going to continue 20 years ago with the tech boom. Everyone thought the tech stocks would go from ridiculous to ludicrous to way, way, way over the top. And of course, all these things come to an end. So the prudent thing to do is to be ready for that, to be ready to buy companies we think are always good, left behind. Buy your straw hats in winter, buy companies when they're out of favour. That is the number one rule to making money in the share market, has been my career-long belief. And right now, those stocks are very much in the value camp. Globally, a slightly different story, where you can see again value on the left-hand side there has tended to work very well over time, but it did have a very tough period in the past 10 years, and that's all down to the Fed. When the Federal Reserve, at the end of the day, yields, bond yields, inflation, those sort of things really drive the market. And for 10 years, the Federal Reserve has been printing money, has been holding down rates, and that's been really warping the market. And we see the results on the left-hand side. Instead of having value outperform over the long term like it normally does, it's pumped up the growth side of the market, the Teslas of the world, the Beyond Meats. Some of these companies have good future potential, but the problem is usually those stocks race ahead to extremely high levels. And on the right-hand side of this chart, you can see there, just the top 5 stocks is usually, when it gets very high, very concentrated, is a sign that a sort of a bubble has formed. So the tech bubble 20 years ago, again, the top 5 stocks made up 18% of the market. It was a sign that there was just too much money chasing too few stocks, those growthy names. And the same sort of thing has happened recently, where the market got to about 25%, which were in the top 5 stocks. Think the FANG stocks. And of course, one by one, we are starting to see a few of those companies experience some trouble. Meta, or Facebook as used to be known, couldn't do anything wrong at one point. Now it can't do anything right. And the difference, of course, is when the news always goes one way, the stock keeps going up, but that's reversed very quickly. Same with Netflix. Remember what a growth engine, it looked unstoppable. But we've seen this many times before. Every 10 years, 20 years, these companies come along, people pay too much for them. there's a disruption of the growth model and they fall over. And they're the ones we think we've got to be wary of. And instead, there's always companies left behind that are overlooked, that are unloved. And that's where we tend to find is the best place to invest, especially during periods of volatility. If you look at the Australian market, and we divide the market up into growth and value stocks, the same sort of thing has happened. We don't have as many growth stocks in Australia. CSL, Zip. Anyone own Zip? On the way up, on the way down? It's been a tough ride. Afterpay at least got bought out. But they're the sort of companies that are in the light blue at the top there. You can see what's happened. We had a bit of what Alan Greenspan would call irrational exuberance, and people put money into some of these names, which were fine at a certain point in time. Then they kept putting more money in, and then eventually they'd be prepared to pay any price to get exposure to these companies. That's when it gets irrational, and that's where you saw Zip get to those incredibly high levels. Sezzle, a similar sort of name, and many other companies in the market, and that's where we reached a peak similar to 20 years ago at the height of the tech bubble. That is over, but it's not finished. Those stocks still have some down cycle to come. So trying to grab a hold of those stocks, like catching a falling knife, is going to be pretty difficult. And instead, we think the dark blue, the value stocks, energy, materials, those sort of companies are still very, very cheap. We think the growth ones are the ones that are a bit more troubled. Of course, driving all this has been the bond market, and we can see how, people once said not that long ago that bond yields are never going to go up again. It's a new era, deflation, demographics, bond yields will never go up. They're in a one-way downward spiral forever. Turns out not to be the case. And that has put a spear into that growth bubble in particular that we saw on the previous page, and why it's starting to come home to roost again. So, and of course, I think, again, because of that anchoring thing I mentioned, people are thinking, well, we used to low inflation, therefore this high inflation thing must be temporary, therefore I'll keep predicting it's going to come down. And we saw that again this week. Remember, everyone on Wednesday agreed that inflation had peaked, it was going to come down, peak inflation. If you Google peak inflation, you come up with about 10 million findings. And of course, what actually happened was we're not at peak inflation. There's something else going on. It's much more difficult to get under control. And we saw trillions wiped off the Dow and the NASDAQ as soon as trading opened, as soon as the inflation report came out. And all I'm saying is, again, we're not trying to be the smartest people in the room. We're just saying that history does tell us that these things, once they get a run underway, they're harder to bring back under control. And it's not a new era, but inflation will probably be a sticky problem for longer than people expect. Not that long ago, the head of the Reserve Bank told us he wasn't going to raise rates to 2024. How did that prediction turn out? Not very well. And that's why you've got to be careful about forecasting these things. But the real lesson here is inflation's here. It's come in a way that people didn't expect, and it's working its way through the economy in a way that people didn't expect. And I think that's the challenge that we have over the next couple of years. And I think we've still got issues to come. In terms of market forecasts for what they're worth, on the left-hand side, the Reserve Bank, the market still thinks that we're heading towards, in fact, probably slightly higher than this now, about just shy of 4%. This week, the market first thought that the Federal Reserve would finish below 4%. They now think it's going to be more like 4.3. Nobody knows, but I would prepare yourself for the fact that rates may have to go higher for longer than people expect. And we all know the consequences of that is that some of those assets that have gone up too much will come down further than people expect, is my general sense. And I think there's always places to hide, but I think they're the ones that people haven't been invested in for quite some time. And you can see there on the right-hand side, again, the talk now that they're not going to raise rates by 75 points in America. The next one will be 100 points. Who knows? But we'll soon see. When rates are rising, as I said before, you can see at the top there, it's the growth stocks that really struggle. Defensives, food and tobacco, healthcare, those sort of names globally, they tend to struggle. They're the glamour stocks, the high PE stocks. This is a European index, but I could run this for the US, Australia. It would be the same. So you've got to keep your portfolio diversified, but I'd be careful about having too much exposure to those sectors at this point in time, given the inflation and rate cycle to come. On the bottom there, you can see the sectors that do really well. The banks, cyclicals, autos, insurance, energy. They're the sort of names that actually benefit from inflation. You can make money out of inflation if you're pointed in the right direction. And I think there's plenty of opportunity to do that. But again, as we've seen, particularly energy stocks, and I think, eventually energy will be challenged to some degree, but I think particularly gas will be around for a long, long time to come, especially as a transitional energy, and people will certainly make money out of that over time. The great inflations, I did spend a bit of time early this year talking about it, but I've still got it in the presentation because I think it's very relevant. But it is a reminder, inflation in the 70s, how did we let go? How did it get out of control? Why did we let it go? The first thing was we had LBJ's war on poverty, and that saw that inflation bounce there in the late 60s. So Kennedy was assassinated, LBJ came in. Part of the Democratic plan was to eliminate poverty. We're wealthy 20 years after World War II, various programs. And they spent a lot of money doing it, a bit like the COVID packages. The problem was, of course, it causes inflation. Now, that inflation, as you can see, then went away, but it came back again. And Nixon introduced a family assistance package in 1972, which was mammoth, and it caused inflation to take off again. People now, in hindsight, rewrite history and they say, oh, that was all oil in the 70s. But the first lump and a half of these three bumps were actually policy-induced, or policy mistakes in a way. So the oil price strike didn't happen until October 1973. Then inflation went double-digit, and then you had a second one in 1978. But the point is twofold. Once you get inflation underway, it's hard to get rid of, and it can come back. And the second thing is, notice the trend. The trend's not even, the trend is rising. And the Fed's very focused on this because they realise if they don't get it right in 2023, then this could repeat. And that's why I think they'll raise higher for longer to try and get inflation under control. They do not want to go down in history as the people that get out of the bag like they did in the 70s. So on the right-hand side of this chart, there's a lot of white space. We don't know where inflation will wind up. But again, people will keep getting surprised unless they take the Fed and the rate hike cycle seriously. They're here to get rid of it. They're not here to pussyfoot around, and that's the big lesson of the last few weeks. And some things we're focused on, clearly, the trade war is here. Trade liberalisation is reversing after 30 years of globalisation. Well, the last time we had globalisation really in place after World War II, it was a great thing, but it fell apart before World War I, 1914. 1914 to 1945 was a period of deglobalisation. There is a risk that relations between America and China are so bad, we may not have those repaired for some years to come. I don't think anyone's going to be rushing out and saying that globalisation is going to be reintroduced in the next few years. I think this is a dangerous decade for all the big global powers, and that just means, I think, higher cost, more domestic production, deglobalisation to some degree, which will push up costs. COVID stimulus, very, very effective, but quite inflationary. We have a lot of follow-on inflation. The number that actually shocked people 2 days ago, which shouldn't have been shocking at all, is that sure, energy prices are going down, but guess what's going up in the US? Rent is going through the roof. And how much bigger do you think rent is as a component of CPI in America than energy is? About 6 times. It's 30% of the basket. Energy is only about 5%. So energy is going down, sure. Rents are going through the roof. Now, one economist in America has predicted that rents will go up from the 6% per annum they're printing now to about 10, 15%. So inflation could be going up again based on those numbers. Who knows? I'm just saying these things are hard to get rid of once they start. Geopolitics, I've already sort of mentioned, are here, and I think that puts upward pressure on inflation and rates. Demographics. Now, there's a general thought base that demographics are low inflation. They're good for inflation. Look at Japan, aging population, low inflation. But what if Japan is simply another low inflation economy in a low inflation world that's now turning around? Because if you look at what the IMF did a few years ago, they modelled what happens to ageing societies. As you age, inflation goes up. And think about it. Think about your own lives. How much did you save when you were 5? How much did you produce and save when you were 5? Nothing. You were a net consumer of products. How much did you save and produce when you're 10, 15, 20? Maybe 25, you're earning money. 20, 25. When did you start saving? In your 30s? And you're probably saving well and truly into retirement. At what point during your 60s and 70s do you stop saving and you start drawing down on your capital, which everyone will do. Everyone will do. And I hope everyone has as long a life as possible, but it means more drawdown of capital. So you're not adding to savings, therefore that should be putting upward pressure on rates and inflation. And sure enough, that's exactly what the IMF data showed. So I think it's a bit of a furphy to think we're ageing, that means lower rates. I think it could actually mean the opposite. Decarbonisation, I think it's a laudable goal. I think we should decarbonise where we can, if we can. But it means a lot more cost. I think it's a good thing that we reduce pollution where we can, but it will be costly. And inflation expectations and wages, the more inflation stays in the system, the more wage claims are put together. Look at what's going on with the union claims right now. Very rationally, I think. Inflation's much higher, therefore our wage claims should be higher. Therefore, guess what? Inflation will be higher again. And so will the wage claims, as we used to call it in the 70s, a wage price spiral. So there's a risk of that as well. So look, I'm not bearish about these things, I'm just realistic. And I just hear people saying, oh, it'll all return to normal again soon. They've been saying that for 2 years. I just think this is kind of how things used to be. It was always difficult to keep a lid on inflation, and that period is back. And of course, as always, I think markets will respond rationally to that. So looking at markets, look, over the last 50 years, this is the US, and this is a bit of a technical slide. All it means is when it's going down, values outperforming growth. And you can see that's been the normality of history. You do get periods where you get a growth bubble. The late 70s, growth went up and peaked between 1976 and 81. But then value came back, leading into the 87 crash. You then had a period where growth went up again just after 91, and then value returned. And then 2001, you had a big growth bubble and it blew up. And then value took over again in the aftermath of the dot-com bubble. But what happened after 2007 is that by keeping rates so low for so long, printing so much money, we had this extraordinary period where growth did very, very well. Now, we appear to have reached a turning point there. And either we return to the normality of history, which is value should outperform, and I think that brings to an end that sort of abnormal period of growth outperformance. So I just think we've just got to bear that in mind when we're investing accordingly. And lastly, in a very common sense way, if you think about it, every 10 years, stocks are a passing parade of history. This is something I've been interested in ever since I first started covering this in the 90s. But notice this, is that every 10 years, every rooster, one decade, is gone the next decade. Now, they might eventually come back again, but every rooster becomes a feather duster and vice versa. So look at that, 1980. If you invest in the top 10 stocks in the market, this is why you've got to be careful about, following the crowd, so to speak, I think. But if you're investing in 1980, you would have bought IBM, AT&T, Exxon, Standard Oil. They would have been the bulk of your portfolio. But 10 years later, they were all at the bottom. And the stocks, you would have had a bit of Eastman Kodak as well. The stocks to buy were all the Japanese. But the biggest mistake you could have made was to put all your money in Japanese shares in 1990, just because they made up the largest part of the market. But they were 8 of the top 10 stocks. They all disappeared. And then 10 years after that, we know what was the place to invest in 1990 when no one else wanted it, and that was tech. Because tech, Microsoft, GE, a couple of Japanese names, but Cisco, Intel, the Lucent Technologies, they were the dominant firms. And of course, the biggest mistake you could have made once they'd done well is to buy them at the top, which is where they were. And of course, 10 years later, we saw a complete regime change again. The place to be was resources, energy, Exxon, Petro. Apple did well, and Microsoft, but BHP, ICBC, Petrobras, it was basically a very bank and resource-dominated world. 10 years after that, we're back to tech again. But I think, as I said, because they're the top 10 stocks, because they're the biggest sort of exposure in the world, they make up such a large share of the market, I'd be wary about buying what's at the top, and I'd be looking at what's at the bottom. And one of the smallest sectors in the world right now is actually energy, ironically, even though we've had this big rebound. I think energy will be scarce for a long time to come. I think nickel, all those sort of critical green metals for electric vehicles, we have nowhere near enough production underway to satisfy the global demand coming. But again, whatever's at the top, whatever make up if you see a theme in the top 10 stocks around the world, in Australia or elsewhere, I'd be wary of what they are. Some value sectors are what you call cyclical, some are more defensive. Financials, energy, materials, industrials, they're cyclical because they do cycle up and down. Even if they're in a rising trend, they will be quite volatile. Defensive sectors, utilities, healthcare, consumer, telecommunications, again, they tend to be a bit more defensive. Sometimes can get a little bit expensive, but you've got to time your exposure to these things. We tend to, when we're investing globally and locally, have a mix of these sectors because we think they've all got an opportunity to do well. At this time, I think those big growth sectors, especially information technology, are the ones, as I said, to be wary of. And from our point of view, we try and balance this. So if you look globally, sometimes we'll be overweight cyclical stocks, sometimes we'll overweight defensives, all in the value camp. But the timing of those things depends very much on where the economy is at. And at the moment, we think defensive value is the place to be, given where the economy is at. We do certainly have some energy in the portfolio, but we've probably overweighted ourselves a bit more to higher quality names at this point in time, given the difficulty that some of the cyclical stocks may face. But the cyclical stocks we do have, they're very much long-term positions we want to have in the portfolio. So if you look globally, companies like Merck, Air Products and Chemicals, Oracle, National Grid, Hess, 7&I Holdings, largely a quality defensive theme there. Hess is a little bit cyclical, but most of them are actually in that more defensive range. And as always, you can see in the bottom right-hand corner there, you want to be paying less than the market for your portfolio. So the market at the moment trades about 16 times. We're more like about 13, 14 times. And again, you can see in that top right-hand chart there, we can find a few IT companies like Oracle, for example, but, IT makes up 22% of the market. That's huge. We want to have much less exposure than that because we think as a sector, as a whole, most of the stocks in that sector are overvalued and probably still got some downside risk to their prices. And in terms of domestically in particular, look, there's probably a couple of things we'd note. First of all, food and energy inflation likely to persist. Incitec Pivot has been a key stock of ours. I'd say really more Santos would be the stock we have exposure to now. We think it's a great business. They're under pressure to sort of break up and realise some value from that business. It's mostly gas reserves in Papua New Guinea, which have got partnerships with other global firms. They're in a very good position long term, we think, to exploit those reserves. Green metals, as I said, Oz Minerals, Iluka, Jervois. A big theme underway is you'll often find US Department of Defence people in Australia at the moment because they're talking to Australian companies about securing long-term supply of things like rare earths and so forth, because most of the rare earths come out of, tricky parts of the world. Most cobalt comes out of Africa. Essentially, we've got all these things in reserve. Once upon a time, people probably weren't prepared to pay up for them, but as they look forward and they realise it's important to have critical and diversified exposure to these sort of minerals, then the demand for those sort of companies is in very high demand, which is why those stocks have gone through the roof, but they still have some upward potential. There's also business models that actually benefit as interest rates rise. The banks have already had a pretty good run, and we're conscious of the fact that they've bounced quite hard. We've actually found less value in the banks. We find, for example, instead, the insurers, particularly IAG, also Suncorp, are probably the best place to be. And we have bought a lot of IAG over the past couple of years. And the reason there is twofold. Nothing lasts forever. And, once upon a time, IAG used to trade at about $7 or $8 a share. Now they're trading about $4, $4.50 a share. The quality of the business is the same. Now, people have different views about insurance, but we will always need insurance. We will always need insurance. Because if your house burns down, who has, the $500,000 or $1 million in your pocket ready to go to rebuild it? You always want to pay a small portion of the capital value of your house to rebuild it if necessary, to prevent yourself being financially wiped out. So I think people sometimes say, is insurance on the way out? Well, I think even though events will rise in frequency and so forth, as we've seen, floods, droughts and whatever, as a general rule, some of those are good for insurance, some of those are bad for insurance. Floods are much worse than fire, for example, so they're of different levels. But insurance will always be there, and we'll change the pricing of the insurance to make sure that people are still able to prevent themselves being wiped out in the event of a catastrophe. But generally, as a rule, during wet periods, insurance does not do well. The premiums go up, but their claims go up. But when the wet stops, the premiums stay high as they through a strong cycle, but the claims start to drop. Now, whenever that happens, you see the insurance stocks do very, very well. It's a much stronger period for them. So we're heading into one of those periods at some point in the next 6 months, 12 months, 18 months. We don't know, but it has happened repeatedly throughout the whole of history. It won't rain forever. It won't be dry forever, and it won't rain forever. We'll have different cycles. Right now, people are trading those stocks as though the rain will never stop. Now, we're probably going to have another La Nina event, which will be only the 3 La Ninas has only happened once in the last 100 years. But that's there's never been a fourth one. So at some point, we will come out of the rain. We'd rather buy IAG at half the price it used to be rather than wait 2 years and buy it at double the price, if you know what I mean. So that's the rationale for that. And also, coming out of COVID, look, everyone bought furniture, everyone bought a new house. Some bought a house and furniture. But coming out of COVID, people want experiences. They're turning back to experiences again. So you see the experiential stocks, so to speak, the event hospitalities, which hasn't risen yet. Certainly the Qantas's have. So we bought those very early because we could see that they were coming out of the COVID, on the other side of COVID, in very good shape, and we wanted to be there. Globally and locally, businesses with pricing power as well. So think about Danone, a great European brand. Think about, great companies in Australia like Brambles, logistics firm. Everyone needs logistics to move their goods around the world. The power's very much in their court. They've got pricing power. They're able to pass it on for the first time. Those sort of companies are in a very good spot. And also things like floating rate credit, very, very important to bear that in mind. You can't just buy stocks. You can also buy credit and other instruments like that. We think floating rate credit's actually a good place to be. And essentially what happens is they're securities people don't know a lot about. But as rates rise, their income goes up. So you think about fixed income. You think about most of the bonds you own, or most people own in the world. The conundrum is that when the rates rise, the price of the bond drops. Now, people only realise this during periods like now, when they pick up their statement, they realise the capital loss on their bond is bigger than the income they got from it. It's simply because they call it fixed income for a reason. You get a fixed income and the price is the thing that changes. Floating rate credit is the opposite, where the capital stays the same, but when rates rise, they just increase, they reset the income to a higher level. So most of the money we manage on the fixed income side, or the bond side, I should say, is actually floating rate. It's not fixed income. And even though the share price of those things move up and down, the income keeps rising and the capital is quite stable. So they're, again, another sort of hiding spot, so to speak, for people in these difficult times. What is less interest to us, we don't think there's actually necessarily a buying place for a zip of the world. Some of the stocks that are in trouble, some will bottom and bounce again. I don't know if you remember, Priceline fell 90%, but then it recovered. Amazon fell 90% back in 1999, but it did recover, but it could have gone broke. But where's DavNet nowadays? Anyone remember OneTel? Tell your friends about OneTel? Maybe not. Gone. Just wiped out. So the biggest risk you're... That's right, 100%. That's exactly right. I remember, and it was a great learning lesson, obviously, for Jamie and for Lachlan. But at the time, they kept pouring money in. You know what? Any investment that looks glamorous and sounds like it's a good thing, it sounds too good to be true, and and the most dangerous ones is they feel as though they're part of the zeitgeist. You know, it's techie, it's trendy. This is a tech stock, therefore it's going to keep on going up. But if the business model doesn't make sense, or they can't make money, or whatever, at some point there's going to be a problem. There's going to be a collision. That's it. Your cash flow is critical. So in the case of OneTel, you could dress up the books however you want, but it just wasn't making money. And the two young Packer and Murdoch boys were pouring money in. And one day, Kerry Packer just said, I want to look at the income statement, the balance sheet. He realised immediately it wasn't making money, and he shut it down. And that's the other big lesson: is that you're not an Adler, is it? Correct. And if you're not making money in your own business, and you're dependent on someone else, that person can close you down whenever they want. If your only source of capital is to raise shareholder capital again, at some point they'll say we're not putting any more money in, or the bank's the same. So that's, again, we haven't had to face this for 15 years because the Fed kept on bailing everyone out. The Reserve Bank kept bailing everyone out. The government kept bailing everyone out. Right now it's the opposite. They're all trimming, they're all cutting, and it's every company for themselves. And as we have seen, we used to see in 2000, in 2007, in the 1990s, at the end of that, when the music stops, only the quality companies survive, and the expensive ones or the ones that don't make money are in trouble. And we think the Zips of the world are very much in that focus. And look, CSL is a great company. It's a wonderful company. I'm not going to talk it down. We think it's one of the highest quality companies we've ever known. But it is also pretty pricey. And in fact, most global investors come to Australia and say, why can I buy Pfizer for 15 times, but I have to pay 3 times the amount of money for CSL? And it's like, well, people just love CSL. But, you know, do you buy the Pfizer that actually invents a COVID vaccine, or the company that distributes it? You know, I think at some point there's, again, a bit of a conundrum that's got to be worked out there. And also the FANG stocks as well. I think for various reasons will face challenges. So from our point of view, look, we offer a number of funds. I just thought I'd mention only these ones today because they're listed, and they're probably well accessible by you, but they're all ASX listed. So PIC, that's a concentrated equity fund, so it invests in about 15 to 25 stocks, a little bit up to 35% offshore. ASX GIVE GIVE is the ethical SRI fund. So that screens out energy and other sort of unethical businesses, unethical industries that people don't want to have exposure to. So that's a choice that people can make. A third of the performance fee goes to charity as well, which is something nice. ASX GLOB, we only launched this a couple of months ago, but that gives you global exposure to those value stocks, as I mentioned, that we think are doing well. ASX IDEA, that's actually more of an innovative company, so it does buy some of those more innovative businesses, companies that are sustainable, but certainly which have been a bit more challenged of late. But if you're betting in the long term on those growth stocks coming back, that's where you want to be there. All of these are value except for that one. And the ASX PCI on the right-hand side there, that's the one I mentioned before, which is in floating rate credit. So again, we can buy some fixed bonds in that portfolio, but it's overwhelmingly floating rate credit, which as rates rise, its income goes up, and we think the income could be heading towards sort of in the 4 or 5% mark before, or even more before the rate cycle is finished by the Reserve Bank. So I just sort of leave it there. I just sort of thought I'd leave a few minutes for questions. A little bit early before lunch is never a bad thing as well. Oh, good. Questions, different views? Yeah, of those previous 5, 2 are closed-end funds. So PIC is closed-end, PCI is closed-end. The others are ETFs. Yeah. Usually what we find is we can buy loans as well in the PCI fund, for example, and we also like to buy some microcaps, large caps through to microcap in the PIC. So the general rule is the more, if you want to have kind of exposure into especially some illiquid sectors, then you want to have the vehicle closed end to ensure you can invest long term. Whereas the others, the ETFs, they're highly liquid. You can put money in that any day. Yeah. View on 10-year yields going to 6% in time frame for that. Look, it may well happen. A lot depends on where inflation goes from here. I think at the moment 3-4%, even 4% this cycle might be sufficient. It really depends on how serious Jerome Powell is in the next 12 months. The cycle beyond that, who knows? And also, I don't think necessarily we're going to get a repeat of kind of 7% per annum inflation and up double digit 3 times like we did, or 2 times like we did in the 70s. I think inflation probably just gets elevated to 3. It's sort of 3 to 4%. And the problem we get is it'll be difficult to get it back, get the toothpaste back in the tube, so to speak, once you let it out. But it won't necessarily be runaway inflation, but it might be just constantly pushing up. We're used to the fact that inflation hasn't been high enough. We're trying to get it up. Instead, I think it'll reverse. We'll be trying to keep a lid on it for the next few years. Unless you have a crisis of some kind. I'll tell you what'll send, actually yields will go down, but inflation will go through the roof. Let's hope it doesn't happen. But if there's a war over Taiwan, you think the supply chain problems are a problem now? Wait till you see Taiwan and China out of the picture. It'll be revolutionary. Now, look, let's hope that doesn't happen. There's a very real chance it won't, but there is a chance it will. And again, if you think the chance of that is 30%, well, you've got to have 30% of your portfolio ready for the very high inflation that might come out. So I think that's where, from our point of view, you've got to take this stuff, have an eye to that, even though it might be 3 to 5 years away. The thinking generally is that if anything is going to happen over Taiwan, it'll probably be this decade. International relations theorists have been talking about this. All the stuff we talk about today, they were talking about it 10 to 20 years ago, preparing for the fact that 2020s is what they call the dangerous decade. I think if ever there's going to be a war, that'll be it. I was just thinking that'll probably see bond yields plummet, though, as people rush back into bonds. But inflation would certainly be high. Where does climate change fit in with your investment thinking? A very real problem, and I think that's why I said I think decarbonisation is actually a laudable goal to achieve. I think there's 2 things to bear in mind. Number one is making sure it's time appropriate. I think, for example, I reckon the market will achieve net zero by the middle of the century anyway. Even the most conservative companies are kind of preparing themselves to get net zero by 2050. If you really rush it over a 10, 15-year period, though, that could really cause some very high costs to come out of it. Think about it this way. Most over a 30, 40-year period, most companies are going to replace, most energy generators are going to replace all their infrastructure anyway. All the coal mines get shut down, new operators get opened up. But if you close down new ones and replace them too quickly, the capital cost of that is very, very high. So I think it's going to happen anyway. I think prepare yourself for the fact that it might cost more, especially if we rush it in a very short time frame. And I just think not only is it price-wise, there just aren't the resources in place. We could have shortages of nickel, copper, aluminium, all these sort of things. Whereas over a 30, 40-year period, the market can plan for it and companies can plan for it, and the price disruptions are much less. Oh, properties, yeah, fine, absolutely. This one here is this. Yeah. Have the land tax change in Queensland impacting MSF's investors? Yeah, look, I'm not. I only sort of read very briefly about those changes. They do. They do. It does feel like a shortage. I think there'll be a shortage issue though coming out of that. Is my gut feel on seeing that. So yeah. So look, without going to the particulars around it, it does feel as though usually when you put too many taxes on there, multiple layers of taxes, whatever, you wind up with either a demand or a supply problem. You cut rates too much, you give too many tax incentives, you've got a demand problem. Get rid of them, you've got a demand reduction problem. I think this sounds like more of a supply side issue. The biggest thing with property we've got to do, frankly, is just get rid of red tape. You know, I think on the edge of Sydney, whatever it costs now in Western Sydney, I think it's like $700,000-800,000 for a property. About 30% of it is tax and charges and regulation. So if you think about it, you know, if we didn't have those layers of regulation and cost, in other words, the new home buyer, the new developer is bearing all the cost, and there's virtually no tax on existing property anywhere in the system. So I think that's something we've got to tackle long term rather than these other measures. Terrific. Thank you very much for your time.
Well, thanks very much for that, James. Very, very informative as usual. And just on that Queensland property issue, I know of one SMSF trustee already who's told me that he is divesting all of the Queensland properties he holds in his portfolio simply because of that change in the tax laws. And look, I'm not really sure how it's going to progress, but I suspect that it will be challenged in the courts of law probably in the immediate future, actually.